Markets reacting and investors closely watching and waiting after President Trump announced another slew of tariffs to take effect August 1st, including a 35% levy on all Canadian imports and potentially raising blanket tariffs on most trading partners from 10 to 15 or 20%. Here with what investors should consider is Westwood Group Chief Investment Officer Adrian Helfert. Adrian, thanks for joining us today.
Thank you for having me.
So once again, tariffs in the headlines. How do you think investors either should react or maybe should not react as the president announces these levies on goods from Brazil, Canada, and others?
I think that traders have already started talking about something like a 24 to 48-hour rule on reaction. These are normally now used to effectuate non-economic means, and it's not a huge impact to the market given how fast things can change. They might change premium to some degree, but it's not a major impact on markets in a very quick fashion. We need to be careful of that. One thing that investors are missing, and one thing we evaluated on that April 2nd day when we saw the card go up with tariffs go across nations, is are we playing an end game that is going to be reducing financial deficits or trade deficits? Those two things are not in coordination. Or are we looking for a security apparatus to make sure we have energy, food, pharmaceuticals, rare earths, and chips all secure in the United States in production, even if they're not all in the United States? And as you start to look at companies like Merck that are putting facilities in the United States for production, or as we saw this week with MP Materials and the government taking a stake in MP Materials to ensure that we have rare earths and potentially rare earth refining even in the United States for magnets that we need for defense. Those things are, I think, a bigger focus and an investable focus for investors.
That's a really interesting point, because either you get revenue or you get domestic industry. You don't get both, right? Because if we're making it here, no tariffs. So you think it's more about the manufacturing domestically than it is about raising money through tariffs?
I truly do.
Okay.
I think it's helpful to have raising money. We
Sure.
want to be able to generate more to pay down the national deficit. But I caution investors to focus on those areas where we see key security paradigms. And you can see it in mentions. And now you start to see it in what the government is ensuring that the United States can have protective positions on. Like we've always spoken about energy. Now we're looking at pharmaceuticals to make sure we have key pharmaceutical manufacturing in the United States. We have rare earths in the United States as that becomes a more dominant industry in those areas.
All right. I want to pivot to earnings next week. The banks, of course, will be announcing, but a bunch of other companies too. What do you think might be a surprise for investors next week?
I could tell you what I would like to see. We'll have Wells Fargo and JP Morgan reporting earnings, among others, next week. Now, JP Morgan has already done an investor day where they talked about a reasonably positive outlook for where they were. They've been very much communicating their capital position. We saw the stress test across the banks that gave a pretty rosy outlook for the capabilities. Wells Fargo just recently had more of their asset cap lifted so they can get more acquisitive. What's going to be surprising to investors, I think, is how much banks start to talk about consolidation. We are still a really fragmented banking industry in the United States. I think Wells Fargo is positioned to potentially take advantage of that. They've got an asset cap that was placed by the Fed in 2018. With that lifted, I think they'll start looking for ways to raise their asset base, consolidate further, and they're already trading cheap to their peers, so we find it to be an attractive opportunity.
That's really interesting. I'd love to pursue that, but I want to ask you, you manage something that's kind of interesting in the sense that your fund can own equities, it can own bonds, you can just stick in cash. Most funds are more constricted than that. So at this moment, are you heavier into equities? Are you overweight equities? Are you more into fixed income? Where are you positioned?
We are heavier into equities. We like the environment, actually, for being supportive. We have a Federal Reserve that the question always is not what we're often asking of when they're going to cut or how much they're going to cut. It's can they cut? And we are in a position to support or suppress volatility when it rears its ugly head. And so we're looking at that as a positive backdrop. Of course, we're going to see more in this earnings season, as you mentioned, of companies that may tell us more about the consumer. We've already seen very recently with Levi Strauss and Delta as part of this earnings season saying, the consumer's in okay shape. We might see some bifurcation between the high end and the low end consumer, but overall, it's very resilient and more resilient than maybe we expected in April. So we're looking at a reasonably positive backdrop. We are looking at a backdrop of potentially lowering rates in the future or a Fed that at least can suppress volatility when we see economic downturn.
All right.
And that forms a positive bias for us.
Well, thank you. That U.S. consumer just hangs in there. Thanks very much, Adrian Helfert.